Hello, everyone. I am Mubashir Qureshi, and today we are going to learn about accounting, its types, and different types of accounting reports. So at the end of this session, you should be able to explain the nature and role of accounting. You should be able to distinguish between the two types of accounting, which are financial accounting and management accounting. And you should also be able to explain the users of financial accounting reports and management accounting reports. So we are starting with accounting. So accounting is a process of recording business transactions so that accountants can prepare different financial statements. So transactions are the dealings. For example, if I purchase a marker from the shopkeeper, then that is a transaction. And as a result of that transaction, the shopkeeper is able to make revenue and I am able to purchase the marker. And if we talk about business organizations, then they are involved in different transactions. For example, the shopkeepers are purchasing the finished goods and then they are selling these goods to their customers. The businesses are also paying for the utility expenses, for salaries and wages. So we can say that businesses are involved in different transactions and accountants are recording these transactions, and with the help of recording these transactions, the accountants are preparing the financial statements. And these accounting statements are prepared so that the decision makers can make informed decisions. And as we have discussed in the start that there are two types of accounting, financial accounting and management accounting. So now we are going into the details of these types of accounting. So I am starting with financial accounting first. So financial accountants are involved in the preparation of financial statements for the business organizations. So that is their main duty. And these reports, which are prepared by the financial accountants, these reports are prepared for the outsiders. So who are the outsiders? We can say that investors are outsiders, creditors are outsiders, suppliers are outsiders, HMRC, that is an outsider. And all these outsiders want to get information about the business. So these financial reports are prepared for the outsiders. And it is very important to remember that financial accountants need to follow international accounting standards and international financial reporting standards. And accountants are preparing a full set of financial statements for the public limited companies. So what are the public limited companies? So the companies which are selling their shares to the general public, these are known as public companies. And there are different types of businesses. For example, sole trader, partnerships, and companies. I have recorded another video on the types of business organization. You can watch that video and it will give you more information about the types of business organizations. And accountants are preparing a full set of financial statements for the public limited company, and that is mandatory. And that full set of financial statements consists upon 4 financial statements. And these are statement of profit and loss, which is also known as income statement, statement of financial position, that is known as balance sheet, cash flow statements, and statement of changes in owner's equity. So now I am going into the details of these financial statements. So the first financial statement which we are going to discuss is the statement of profit and loss. So why this statement is prepared? So this statement is prepared to check the profitability of a company. So the next question is, what is profitability? I will explain you about profitability, but first of all, I want to, to describe or to define the two other terms. And these two terms are revenues, which are also known as income, and expenses. So what is revenue? So business organizations are involved in the operating activities. And as a result of that, these business organizations are able to generate revenues or income. Some businesses are selling their goods to the customers. For example, these small off-license shops, they are normally selling their goods to the customers. There are some organizations which are providing their services. For example, a firm of accountants, a firm of solicitors. These organizations are providing their services to the customers. And if we talk about Tesco, then it is selling its goods and services to the customers. Okay, so that is revenue. And second is expenses. So the cost incurred for the generation of revenue, that is known as expense. And businesses need to pay for different expenses. For example, insurance, salaries, wages, utility expenses. So all these expenses are incurred on the daily basis, and business organizations need to pay for these expenses. And accountants transfer revenue and expenses to the statement of profit and loss. So expenses are deducted from revenues, and as a result, we can say that organization, we are able to calculate the profit, but it can be a loss as well. I'm going to give you an example, and with the help of that, I will explain you what is profit and what is a loss. For example, I want to purchase a marker. I went to a shop, I purchased a marker, and that marker has cost me £1.50. So I paid 150 to the shopkeeper. And after that, I asked him that you are selling me this marker in 150, but can you tell me how much actually you spend on this marker? Because I know that you have purchased that marker from the manufacturer, you are paying for different other expenses. So can you tell me how much actually you spend on one marker? So the shopkeeper told me that he spent around 120 pence on the marker. So if we deduct the expenses from revenue, then the difference is profit or loss. Remember, if the revenues are greater than expenses, it is profit. And in my first example, you can see that the revenue is 150 and expenses is 120. So revenues are 30 pence higher than expenses. So it is profit. Okay, and now I am going to amend my example. Let's suppose I went to the shopkeeper. I said that I want to purchase a marker. So the shopkeeper told me that the marker is of £1, is of 150. I said it is too much. I can't afford that much. So the shopkeeper said that, okay, I have few other markers. If you want to purchase any of these markers, I can sell that marker to you in £1. And he said that he is selling that marker in £1 because the packaging of these markers is damaged. and he is sure that no one is going to pay 150 for that marker. So I checked the marker. So only the packaging was damaged. So I paid £1. I purchased that marker. And after that, I asked him that how much you spend on that. He told me that I spend 120 pence on that marker, but I'm selling you this marker in £1 because the packaging is damaged. Otherwise, I am selling the similar markers in 150. So in this case, if we deduct the expenses from revenue, then this time expenses are 20p higher than revenues. So this time it is a loss. So we can say that if the revenues are greater than expenses, it is profit, otherwise it is a loss. And remember that businesses which run efficiently, they are able to make profit. Otherwise, the inefficient businesses are, if the employees are inefficient, management is inefficient, then these type of businesses are not able to make profit. And it is very difficult for these businesses to survive in the long term. So the main reason for the statement of profit and loss is to check the profitability. And remember that accountant transfer only revenues and expenses to this financial statement. Now I am moving to the next financial statement. The next one is statement of financial position. It is also known as balance sheet. So this financial statement is prepared to check the financial health of the company. Okay, and accountants transfer assets, liability, and equity to statement of financial position. So what is an asset? So asset is a resource of the business. So normally business organizations need to purchase assets. If we take the example of Tesco, for Tesco, then Tesco has purchased, we can say that they have purchased the finished goods inventory, the inventory which we can see on their shelves, fleet of lorries, property, and definitely that property which are using to sell that inventory. So that is there. So all of them are assets. And if we take the example of McDonald's, then the assets which are purchased by McDonald's are quite different as compared to Tesco. They have some raw food items. They have grills. Why? Because that sort of assets are helping them to prepare different food items which they are selling to their customers. So all the organizations are purchasing only those assets which are helpful for them to perform their operating activities. And the examples of assets are, we can say cash, we can say inventories, then motor vans, building, plant, equipment, all of them are assets. The second term which is there is liabilities. So liabilities are the loans. So if a business organization has taken a loan from the bank, then that is a liability. If any business want to purchase finished goods from the suppliers on the credit basis, then again, it is a liability. So all the loans of the business, we can say they are liabilities. The third term here is equity. It is also known as capital. So the investment of owner in the business is equity. Okay, so accountants transfer all the assets, all the liabilities, and equity to the statement of financial position. And one more point which is very important is that assets are always equal to liabilities and equity. And why both these sides are equal? Because business organization need funds, and these funds are generated by taking loans are investors are investing money in the business. So that is how the funds are generated. And the funds which are generated, they are used to purchase the assets. So liabilities and equity are the sources of funds which are used to purchase assets. These are the resources. So that is why both the sides are equal. And one important point is that the organizations which are relying on liabilities, which have generated so much funds from liabilities, normally we can say that their financial health is not good. These organizations are struggling. And what is the reason? Because organizations need to pay back these loans. Furthermore, these organizations need to pay interest on their long-term liabilities. So if an organization has taken or generated funds through liability, then we can say that the company is quite risky and it is not financially stable. Okay, now the third financial statement is statement of cash flow. So this statement is prepared by the accountants to check the cash inflows and cash outflows. So the cash which is coming into the organization, it is cash inflow, otherwise it is cash outflow. Okay, we can say that with the help of this financial statement, we can get information about the liquidity of the organization. And accountants need to divide this financial statement into three sections. For example, operating, investing, and financing. Okay, so all the cash inflows and outflows are divided into these three activities and recorded under these three separate sections. The next one is the statement of changes in owner equity. So this statement is prepared to track the investment of the shareholder in the business. As we said that equity is the investment. So with the help of this financial statement, we can find out how much funds are invested by the owner, and we can track the funds of the owners. Okay, so these are the four financial statements which accountants need to prepare at the end of every year for the public limited company. And remember, it is mandatory. It is mandatory. So every organization has to prepare this full set of financial statement. Okay, so now there is a quiz. There are a few questions which we are going to do. The first one is, which of the following statement is true? So statement number one is the income statement is prepared to check the financial health of the company. So what do you think? This statement is true? I'm sure that all of you have given the correct answer. This statement is false. It is not correct. Why? Because income statement is prepared to check the profitability. This statement is also known as statement of profit and loss. So this statement is prepared to check the profitability. Okay. Statement number two is the cash flow statement is prepared to check the profitability of the company. So this statement is also false because cash flow statement is prepared to check the cash inflows and cash outflows, the liquidity of the company, how much cash company has. Okay. Statement three is statement of changes in owner equity is prepared to track the investment of owners in the company. So what do you think? Is it correct or not? I'm sure that you have given the correct answer that this statement is true. So statement of changes in owner equity is prepared to check the investment of the owner in the business. So statement four is that statement of financial position is prepared to check the profitability of the company. So what do you think about this? So this statement is not true, because statement of financial position is prepared to check the financial position, financial health of the company. And the last statement is public companies must prepare a complete set of financial reports at year end. Yes, it is correct. We have just discussed about that, I think 1 or 2 minutes ago. So that is about the quiz one. Now I am moving to the next slide. So we have another quiz, and we have to identify that which of the following statement is correct. So A is assets are equal to liabilities plus equity. B, revenues are equal to assets plus expenses. C, liabilities are equal to assets plus expenses. D, equity is equal to assets plus liabilities. So what do you think? Which statement is correct? So hopefully you have given the correct answer for that. So A is correct, that assets are equal to liabilities plus equity. And if you remember, a few minutes before we discussed that point, that liabilities and equity are the sources of funds. And these funds are used to purchase the resources, and assets are the resources. So the correct answer for quiz 2 is A. Okay, so now I am moving to the next statement. There is another quiz. So we need to calculate the profit or loss for company A and company B. So for company A, revenue is given, which is 1 million. Expenses are 700,000. So you need to calculate the profit or loss. So what do you think? How much, is there any profit first? That is the first question. And the second one is that what is the amount of profit or loss? So here, you know that when the accountants are calculating profit, what they are doing, they need to deduct expenses from revenues. So the expenses are 700,000 and revenue is 1 million. So it means 700,000 minus 1 million is 300,000. And that 300,000 is profit. Why? Because revenues are higher than expenses. Okay. So now after that, we have company B, and the revenue for company B is 1 million and expenses are 1.2 million. So you need to calculate the profit or loss. So can you calculate it? Okay, I'm sure that you have calculated profit or loss correctly. So we can do it together now. So we know revenue is 1 million and expenses are 1.2 million. So this time expenses are higher than revenue. So it means it is loss. And 1.2 million minus 1 million of revenue, it means there is a 200,000 pound of loss. So that is about company B. And hopefully this is clear to you. Now I am moving to the next slide. So the next slide is related with management accounting. So whatever we have discussed before, that is related with financial accounting. So now we are moving to management accounting. Okay, so what is management accounting and what are the management accounting reports? That is what we are going to discuss now. So management accountants are also involved in the preparation of management accounting reports. But these management accounting reports are prepared for the managers. Okay, so that the managers can perform different managerial functions. For example, planning, controlling, and decision making. So, what is planning, controlling, and decision making? So now I am going to explain these three managerial functions that how we can define planning, controlling, and decision making. So first is planning. So when we use this term, then it means the managers are setting the objectives, are targets for their business organization. So it is planned, so that target is set for the future, that what we want to achieve in the following year. For example, an organization has set the target that we will generate the revenues of £1 million in the following year. So £1 million of revenue, this is the target. Okay, so that is a plan. So the next is controlling. So what is controlling? So control means the comparison of the budgeted amounts with the actual amounts, or the budgeted result and actual result. Their comparison is known as controlling. Okay, so at the start of the year, not at the start, before the start of the year, the targets are set. And what is the target? We said that the target is to generate the revenue of £1 million. Okay, at the end of the year, now we have the actual number. Let's suppose the actual revenue is £1 million as well. So £1 million was the target, and the organization is able to achieve that objective. They have generated the revenue of £1 million. So it means the management, they are efficient, employees did well. They have achieved the target, whatever they have set, whatever target they set for themselves, they have achieved it. So the performance is quite good. Okay, but there is a possibility that the target is £1 million and actual revenue is 0.98 million, or you can say £980,000. Okay, which is below £1 million. So it means the organization was not able to achieve its objective. The employees and managers, they were not able to achieve the target. So it means something is not right. Okay, so now it is the duty of the managers to identify the weak areas. Okay, so that next year the organization can achieve their objectives. Okay, so the third function is decision making. So if we go back to our first example where the total revenue was the actual revenue was 1 million and the target was 1 million as well. So in that case, what can be the decision? And when we talk about decision making, then it means we need to select the right course of action among different alternatives which are available. So if we achieved what we were expecting, so in that case, the decision could be that our policies and our plans and everything worked well for us. So we should continue. We should continue on the same lines, so to achieve the objectives. So that can be the decision. And for the second example, where we said that the budgeted revenue is 1 million, but actual revenue is 980,000. So in that case, we can say that identification of the weak areas, and then to work on finding the corrective actions, that how we can improve the performance for the following year. So that can be the right decision to find the solution so that we can improve. That is the right decision, and that should be implemented. So we can say that management accounting reports are prepared specifically for the managers so they can perform these managerial functions. And as we said that these reports are prepared for the manager, so we can say that management accounting reports are prepared for the insiders. If you remember, we said that financial accounting reports are prepared for the outsiders, while management accounting reports are prepared for the insiders, specifically for the managers. And remember, management accountants don't need to follow any accounting standards. So no legal obligations, or you can say no legal framework which they have to follow. Okay, and why? Because they need to generate that sort of report which can help the managers. Okay, so that is about the management accounting and management accounting reports. Now, the next section is the difference between the two types of accounting, financial accounting and management accounting. Okay, so the users of the financial accounting are the insiders. Oh, sorry, that is a mistake here. The users of the financial accounting are the outsiders. That is a mistake. Sorry, that is not correct. So the users of financial accounting, they are outsiders, like creditors, like suppliers, like investors, potential investors, like HMRC. So all of them are the users. Okay, and finance management accounting reports, who are the users? The users are insiders, managers. Okay, so financial accountants need to follow the legal framework. They have to follow international accounting standards, international financial reporting standards. But management accountants don't need to follow any accounting standards. Financial accounting reports are providing historical information because financial statements are prepared at the end of the year. So these financial statements are providing historical information for the last accounting year, while management accounting reports are providing historical as well as the futuristic information. If you remember the last example which we discussed, we said that managers need to plan. They have to set the targets. Normally, these plans are prepared in the form of budgets, and the targets are set in these budgets. So these budgets are providing the information for the following accounting year. Okay. The next is time. So financial accounting reports are prepared once in a year, and that is after the completion of accounting year. Some organizations prepare interim financial statements as well, but it is their own choice. Okay, so management accounting reports can be prepared for a year, for a month, for a quarter, for a week, for a day, for a shift in which a particular manager is working. Okay, so there is no specific time period for which these management accounting reports are prepared. The next one is information need, or the information which is provided by financial accounting reports and management accounting reports. So financial accounting reports are providing information for the entire organization, overall about the organization, that profit for the organization in 2020, expenses, total expenses. Okay, while management accounting reports are providing information for the departments, for the subunits. Why? Because managers have to plan, they have to control, they have to take appropriate decisions. So they need information for the small sections of the organization. Okay, so these are few differences between financial accounting and management accounting reports, you can say as well. Okay, now there is another quiz. So accounting is usually divided between the major strands of financial accounting and management accounting. Tick the corresponding strand of accounting that matches the function shown in the left column. So the first item is business planning and controlling. So what do you think? Which type of accounting reports are providing that information? We are talking about planning and controlling. Yes, you are right. It is management accounting reports. Okay. The second one is reporting to suppliers. So what do you think? And I hope all of you are correct. That is financial accounting, because suppliers are outsiders. Yes. And financial reports are providing information to the outsiders. So definitely it is financial accounting. The next is reporting to lenders. So what do you think? Yes, I think you are correct. It is financial accounting. Okay, because lenders are again outsiders. Okay, so that is about quiz 4. Now, the next is quiz 5, which is match the column. So the items are given and accounting and its types are given. The items are given on the left side, and on the right side, you can see accounting and its types are given. So the first item is recording transaction to prepare financial reports. So what do you think? Which one is correct? So three choices are given on the right side. So what do you think? Which one is correct for recording transaction to prepare financial reports? Yes, you're right. That is accounting. I'm sure that you are correct. And if you make some mistake, then you can go back to the slides. You can watch that video again, and hopefully it will be clear to you. The second one is reporting to suppliers. So financial accounting, management accounting, or accounting. So again, it is suppliers, which are outsiders. So definitely financial accounting reports. The next one is reporting to management. This is very simple because it is straight away, it is telling you that reporting to the management. So definitely management accounting. Okay, so hopefully it is correct. As I said, that if you are making some mistake, then you can go back to these lecture slides. You can watch that video again, and hopefully everything will be clear. And if you have any question, you can type your question in the comment section, and I will see your comments, Simon, and I will reply to that as well. Okay, after that, it's a summary of today's lesson, today's session. So we know that accounting is divided into two types: financial accounting and management accounting. Financial accounting reports are prepared for the outsiders, while management accounting reports are prepared for the managers. So it is mandatory for a public limited company to prepare a full set of financial statement. And that full set of financial statement consists upon statement of profit and loss, which is also known as income statement, and it is prepared to check the profitability. Statement of financial position is prepared to check the financial health of a company. Cash flow statement is giving you information about cash inflows, cash outflows, and statement of changes in owner equity is prepared to see how much investment is made by the owner in the business. Okay, instead of that, we have discussed different terms And one thing which I did, let me go to the next slide. I think it is available on the next slide. Just give me a second. So it is not here, but on the next slide, you can see the answers to the quizzes. So we did 5 quizzes and the answers of these quizzes are given here. Okay. Then if we go to the next slide, then here you can see the definitions of the key terms. So all the key terms which we have discussed today, I have highlighted these terms. Let me go back. You can see on this slide that there's revenue, expenses, profit and loss, all of them are highlighted. And why? What is the reason? Because I have provided the definitions of these key terms. You can see them here. The definition of revenue, definition of expense, profit, loss, and some more terms are here as well: assets, liabilities, equity, cash inflow, and cash outflow. So the definitions are provided here. You can go to these definitions again. If you have any problem, then you can revise them as well. Okay, and after that, the list of references is given. And thank you very much for listening me. And if you have any question, then as I said, you can type your question into the comment section and I will reply to your questions. If I have time, I will try my best to do that. Okay, but if you have any question, the best thing is that you can go back to these slides and you can watch this video again, and I think it will be clear. But if still you want to discuss something, you can type your question in the comment section and I will check and I will give you answer to that. Hopefully you are the points which I have the points which we discussed today, they are clear to you. So take care of yourself and stay safe, and I will speak with you soon. So bye everyone.